Welcome back to the Grenadier podcast, Real Estate Uncovered. Today I speak with Sam Whelans from Ashton Whelans, an accounting firm. We discuss the tax implications for landlords. You obviously love this business. Tell me what you love the most about it. Today, an absolute exclusive. Welcome back to the Grenadier podcast, Real Estate Uncovered. Sam, could you introduce yourself to us?
So my name is Sam Whelans and I'm a partner at a firm called Ashton Whelans. We're an old Christchurch accounting firm, been around slightly over 50 years. We have offices in Christchurch, being our main one, Kaiapoi, Wanaka and recently Greymouth.
Wow, so spread over a fair amount of the South Island. Sam, tell us, we obviously work with property investors and there is important tax implications for them. When do you like to meet these investors and help them with their tax structures?
Well, I guess what normally happens is, someone will jump onto one of the free tools online that, financial advisors provide. Which accountants are different to financial advisors. We obviously can't provide financial advice, but they plug their numbers into a tool, and then after they've done that, they go, okay, I can probably afford an investment property. They come see the accountant for their tax/structure advice, really.
And I think that's important, given all the different legislation changes, that they get good advice and not scary tax bills, right?
Yeah, correct. That there's various ways you can structure it, from holding it personally, or if you plan to hold it in a company, that can save you a bit of tax if you don't need to draw the money out. But there has been a lot of changes, to trust tax rates, personal tax rates. So yeah, the structure can differ on your personal situation, really.
So it's always important to get good advice. Obviously, with a new government, there's been changes in that interest deductibility for investment properties. Tell us a little bit about that.
Yeah, so basically in 27th of March 2021 was sort of the last cut-off. So if you managed to get a property just before that, and I had a lot of clients scrambling prior to that date, you went through a phased interest deductibility. So essentially you went from 100% deductible down to 0%, I think, by March 25. If you didn't get a property before 27th of March 21, you had 0% deductibility with a new build exemption. So now, from 1 April 24, which is obviously passed, you're allowed an 80% interest deduction in the March 25 financial year, and then from 1 April 2025, you're back to 100% deduction, which is great.
That's excellent, yeah. And given that interest rates have been relatively high in recent times, most landlords have some form of borrowing, don't they?
Yeah, I'd say most of our clients, if not all of our clients, have borrowing. Historically, from a structure point of view, you may as well have debt that is deductible rather than having a personal mortgage that is not tax deductible. So yeah, everyone has debt.
Yeah. And do you have a lot of clients that not only have one investment property, but obviously are building a portfolio? And is there any tax strategies for them?
Well, the first point would be the structure. If you are looking at holding a lot of investment properties, a company could be a better structure because it's a slightly lower tax rate than the top personal one.
Yeah, and interest deductibility, you want obviously all that debt as much as possible on things that are tax deductible. Is there a way to move, if you've got a mortgage on your own home, can you restructure so that you're sort of putting the debt into your investment properties?
Yeah, and I guess that's a good time to come see your accountant. There are creative ways that you can move debt around to make it deductible.
Yes.
And as I said, you might as well have debt deductible than non-deductible if it's in your personal house.
Well, we always all want to pay our tax that we need to, but of course you are allowed to mitigate those things by talking to accountants who know how to deal with it. Tell us about the bright line test and how that affects landlords when potentially they might be selling their investment properties.
So the bright line test has gone through a whole bunch of changes over it. Went from 2 years to 5 years to 10 years, and the bright line. The new bright line date is the 1st of July, on or after the 1st of July. So anything that is sold after the 1st of July this year, 2024, is subject to a 2-year bright line test. But I would recommend talking to your accountant because there's a few sort of side rules.
Yes, so from the 1st of July, effectively, if you've held the property for 2 years or more and you sell at a profit, that profit is not taxed. Is that the clarity? Yeah. And if you are doing flips, obviously, if you're flipping properties and selling within a shorter time frame, there will be a tax exposure.
Yeah, once again, it comes down to sort of individual circumstances. Your accountant will clarify it with you. But if you have a habit of flicking properties every, and get into a regular pattern, the IRD will probably come knocking and ask you to explain a few things.
Exactly. Are there some pitfalls that investors fall into? Are there some things you could help mitigate for them?
I think the most common thing we see is especially younger investors that leverage themselves right up and don't risk rate anything. You know, what happens if interest rates move slightly? And then they get their accountant to do their end of year accounts, and it might be 1 or 5 investment properties, and all of a sudden we go, well, as of recent, because of no interest deductibility, hey, here's a $10,000-$15,000 tax bill, and they're like, oh well, my rent barely covers my interest at the moment, and now you're telling me I've got a $15,000 tax bill. So that seems to be the main thing that trips people up.
Yes. So they really need to think about tax planning, don't they, rather than waiting to the end of the year to find out, here's the bill, thanks for coming.
Yeah, exactly.
Do some planning.
And be proactive with your accountant.
Can you share any success stories that perhaps you've had or encountered in your business?
I think there is, we touched on it earlier about structuring your debt correctly. I had a big client about 6 months ago, and he's got about 40 or 50 residential rental properties, and we did various restructuring with the bank, and managed to get some debt deductible, and ended up saving him a lot of money. And then I guess also it depends where you buy investment properties. I had a friend that recently moved back down from Auckland and sold his house up there and bought 2 investment properties down here because he already had a house down here, and for basically the same capital outlay, he gets double the rent. Yeah,
that's amazing. And looking around at other locations and doing some really good work, because obviously the tax legislation affects all of New Zealand, but if you can buy 2 for the price of 1, why not? How do you recommend that investors stay informed about trends and perhaps changes to tax legislation?
Subscribe to accounting firms. A lot of the bigger and mid-sized accounting firms will do newsletters.
Right.
Even if you're not a client, you still can subscribe on their websites. And financial advisors, mortgage brokers, real estate agents. A lot of them do it.
Yeah. If someone's looking to get into investment property and they want to come and have a quick chat to you, is that something they can do?
Yes, definitely. Yep.
Yeah.
I'd probably recommend financial advisor and accountant probably at the sort of same time.
Yes.
But as I said, getting that structure right and based on what your goal is. As I said, if you don't need the money to live and it's just sitting there as a passive investment for when you retire, that's different to actually needing the money to pay the kids' daycare or that sort of stuff.
Yes. So depending on whether you're going to be making withdrawals or whether you're leaving that capital in there. Anything else we should know about investing in property?
No. I guess it's it's obviously that the housing market's pretty safe, but I guess risk rate your scenario, and I guess with the 2-year bright line, it's a bit more flexible now. Because,
yes.
For example, if you have children and they're not cheap, I've got a couple of daughters myself. It gives you more flexibility to sell if you need to without getting that big tax bill at the end.
Yeah. Wonderful, Sam. Thanks so much for your insights. It's been great meeting and speaking with you.
Thank you.
Thank you so much for tuning in to Real Estate Uncovered. I hope you really enjoyed the show. If you did, please give us 5 stars and leave a review. This really helps others find our podcast.